The executor's treasury, how to create, manage, and secure a private credit facility under trust law. One. The birth of a private treasury. A private treasury isn't a vault of gold, it's a vault of comprehension. It exists wherever an executor understands the law of value and the mechanics of record. When a trust establishes its own treasury, it no longer begs banks for permission to breathe. So what does that actually mean? It means the bank isn't where the money is, you are. A private treasury functions as the internal accounting center of the trust. It records deposits, assets, issues credits, liabilities, and reconciles obligations through staff rather than payment. It does everything a bank does, minus the usury, risk, and regulation. Footnote. A private treasury replicates core banking functions internally under trust jurisdiction, facilitating credit issuance and staff. 2. Establishing the treasury account. A treasury account begins with a declaration, not an application. The executor issues a treasury charter, signed and sealed under the trust's authority, identifying the account as a private fiduciary instrument. So what does that actually mean? It means you don't open an account, you create one. The charter records the treasury's lawful purpose, identifies the fiduciary officers, and specifies that all deposits represent lawful trust assets, not public currency. Once recorded, this document becomes the foundational asset ledger for all internal exchanges. Footnote. A sealed treasury charter lawfully constitutes a private account foundation, defining fiduciary purpose and ownership. 3. Managing deposits and credits. The executor's treasury doesn't receive money. It receives evidence of value, notes, affidavits, judgments, assignments, and lawful instruments. Each deposit represents trust-owned equity. In return, the Treasury issues internal credit, ledgered as lawful consideration. So what does that actually mean? It means your paperwork is your deposit slip. Every transaction is recorded as value in, credit out. No income is realized because ownership doesn't change hands. The trust merely shifts assets between compartments, maintaining continuous internal possession. Footnote. Deposits of instruments represent equity transfers within the trust, generating non-taxable internal credit circulation. 4. The rule of two signatures. Every treasury transaction should bear at least two authorizations, one from the executor and one from the comptroller, or co-trustee. This ensures no single hand can unilaterally alter the trust's balance sheet. So what does that actually mean? It means one signature runs the trust, two signatures protect it. This dual signature rule creates a built-in safeguard against fraud, ensuring each issuance of credit or discharge of debt is mutually verified, logged, and sealed in the ledger. Footnote. Dual signature protocol provides fiduciary redundancy, preserving integrity of credit issuance and discharge operations. 5. Securing the treasury, the vault of proof. Security isn't about padlocks, it's about proof locks. The executor's treasury is secured through redundant records, sealed ledgers, notarized statements of account, and affidavits of performance. These form a triple-layered audit trail against intrusion or challenge. So what does that actually mean? It means the real lock is your paper trail. If the Treasury's records are impeccable, no public or private actor can lawfully challenge its existence or ownership. The paper becomes the fortress, precision becomes the key. Footnote. Treasury integrity depends on documentation redundancy and verified record-keeping, rendering ownership and performance incontestable. 6. Lawful credit creation, the heartbeat of sovereign finance. Once a treasury ledger is active, the executor can lawfully issue credit instruments such as bills of exchange, promissory notes, or private bonds backed by trust equity. These are not loans, they are extensions of pre-existing value. So what does that actually mean? It means you don't borrow power, you circulate it. Because these credits are anchored in private trust assets and not generated through public banking channels, no taxable event arises. Each instrument must, however, be signed without recourse to prevent involuntary assumption of commercial liability. Footnote: Lawful credit issuance under trust authority represents internal equity circulation without taxable realization or public jurisdiction. 7. Reconciling with the public, the peaceful interface. Eventually, the executor must interface with public systems, banks, agencies, or courts. The rule is simple: notice, don't negotiate. Present your treasury documents as lawful records, not applications. The moment you ask permission, you abandon jurisdiction. So what does that actually mean? It means the system respects confidence, not compliance. The executor stands as the living fiduciary of value, not its applicant. When properly noticed, public officers are duty-bound to honor your sealed records or remain in commercial dishonor. Footnote: Interfacing through notice, rather than petition, maintains jurisdictional sovereignty while compelling administrative acknowledgement.